We're gonna go ahead and get started. Others should be coming into the room at some point, but it's 7 o'clock and I like to get in and out. And
Yep.
so, Patricia, when you start this process, this will be something for you to know that there are options regarding bringing down your payment that has more to do with just refinancing. We're going to be talking about that tonight. So, by the end of this session, you'll know exactly which options fit your situation.
Okay.
We are going to walk through 6 agenda items really quickly, and then we'll summarize. And we're going to start with the real problem most homeowners face, and then we're going to break down both recasting and refinancing. We're going to compare them side by side, look at real client examples, and finish with an action plan. This isn't theory. Every number that we're going to see tonight comes from real Texas mortgages in real client situations. So by the end, again, you'll know exactly which strategy to use, or you'll know the right 2 questions to ask your lender. All right. So now your mortgage isn't just numbers on a page, it's monthly stress for most people. And the numbers tell us why. 38% of people feel house poor.
Almost 4 out of every 10 homeowners feel their mortgage is squeezing them too hard. If that's you, you are not alone.
The average payment is $2,156, which is up 41% since 2020. And again, that's just average. Many people are paying significantly more. The crux of the whole conversation tonight is going to be the 7.2 peak rates versus the 3% pandemic rates, right? If you purchased or refinanced in 2020, 2021, you have something incredibly valuable, a low rate. So whether you protect that rate or replace it is what changes everything.
Many of the people that will watch this video will watch it because they feel this, right? The question isn't, can I lower my monthly payment? The question is, how can I lower my monthly payment?
And the good news is most people only know about refinancing. Recasting is the option that nobody talks about. And tonight, we're going to talk about both. So let's start with recasting because almost nobody understands what that actually is.
Recasting is the best kept secret in the mortgage industry, and let me show you why. Simply put, the definition of recasting is when you make a big one-time payment toward your principal and the lender recalculates your monthly payment based on the new, smaller balance. The magic word is re-amortize. That's all it means. Your lender redoes the math on your loan using the new balance. And how this typically works involves 4 steps. You make a lump sum payment. Typically, it's going to be $5,000 to $10,000 minimum. You pay a small fee, anywhere between $150 to $500. The lender re-amortizes the loan, and then the new lower payment kicks in. And here's the thing, your interest rate is unchanged. Your loan term is unchanged. Only your monthly payment drops because now the balance is smaller. This is huge. Men lie, women lie, numbers don't.
Let me show you what this looks like on a real mortgage. Okay, let's run the actual numbers. This could be your house. These are realistic Texas numbers. So the scenario is a $400,000 mortgage with a 6.5% interest rate over 30 years. And let's say you just came into $50,000, maybe from selling another property, a bonus, or an inheritance. All right. So the loan balance again is 400,000, rate 6.5%, 30 years remaining, monthly P&I of $2,528. That's the starting point, right? That's the starting payment. All right. Now, after the recast is applied, you're going to say, let's say, bring 50,000 to the table. You'll pay a small fee, let's say $250 to do this, and the lender will recalculate your payment. All right. And now the balance is 350 The rate is still 6.5, it's still 30 years, but the payment has dropped to $2,213, right? That's a $315 drop per month, almost $3,800 a year for a one-time $250 fee. And you kept your rate. So let that sink in. That is the power of recasting. Same loan, same payment, no drama. Now, of course, no strategy is perfect. So let's look at the trade offs. Okay. Here's honest breakdown. Every option has trade offs, and I want you making informed decisions, not impulsive ones. All right. The pros: low cost, anywhere from 150 to 500 versus thousands. That's a massive difference. You keep your rate. So if you locked in 3% during the pandemic, this is gold. Don't give that up unless you have to. No income docs, no new application, no appraisal, no credit pull, almost no paperwork is involved in this recasting. The lower monthly payment and the interest savings, the cash flow with the lower monthly payment and the interest savings, the cash flow relief is now, and there's less total interest paid over time. So that's a win-win. Now, here's some key points. Here are the cons. And I want to be honest about this because that's what I offer you. This does require cash. So you would again need anywhere from $5,000 to $10,000 on hand. If you don't have it, this option is just not available, plain and simple. Not all loans qualify for a recast. This is the big one. So the government loans like the FHA, the VA, or the USDA loans almost never allow recasting. You have to check with your lender, but all conventional loans usually do, depending on the lender. Okay. Now, if rates have fallen significantly, recasting won't capture those savings. So that is a discussion for you to now have. Okay. Now, again, as I just stated, and I don't want to gloss over that, not every lender offers recasting. And that $50,000 you use for recasting, if you use it, it's gone. If you took it out of your emergency stash, there's no more available emergency money, right? So you want to think about it, right? Now that's recasting. Now we're going to flip over to the option that everyone does know about. All right. And that is refinancing. And this is the option most people just jump into, but it's the bigger, more expensive transaction. So let's understand what we're really signing up for if you choose to go this route. Refinancing means replacing your existing mortgage with a brand new loan. Your old loan is paid off. It'll show on your credit report that loan is paid off and a new one takes its place with new terms. So you're starting from scratch, new rates, new terms, new closing costs, new amortization schedule, everything resets. Okay. So let's talk about the rate and term. The most common thing that you're going to see and be concerned about with when refinancing it is the rate and the term. Okay. Just lowering the rate or changing the term length can save you money. When we talk about cash out, you borrow against your equity and you walk away from closing with cash in hand. So this is something that I could see someone who has a lot of equity in their home, but they don't want to move, but they have a bunch of debt, like a bunch of credit cards debt. They are wanting to eventually move, but they need to, just kind of get some of this debt taken care of. I've seen people do that. And then there's the cash in. This is the less common one. You bring money to closing to reduce the balance and get better terms. But again, cash in, the better option may be for recast. We would just have to have that conversation and look at your numbers. And then there's the streamline refinance. So FHA and VA have this fast track option with reduced paperwork. Each type serves a different goal. Tonight, we're focused on rate and term because that's the one most relevant to lowering your payment. And now, what we see going on in the economy, people want relief and they want options for how they can get some relief. So, now this is a real world example of refinancing. Same homeowner, but different strategy. Watch what happens to the numbers. All right. So the scenario, $400,000 loan at 6.5% interest rate. But this time the rates have dropped to 5.5. Let's just say, right? 5.5 rates. The closing cost to refinance is going to be about $8,000. Okay. So let's walk the before. Same starting point, $400,000 loan balance, 6.5%, 30 years, 30 years. That gives us a principal and interest payment of $2,528. And then after, because we're going to now roll those $8,000 in closing costs into the new loan, right? And what they're doing is they're borrowing some of the equity that you have to be able to do this. So your balance actually goes up because it's going to go up by 8,000. So now it's the $400,000 loan plus the 8,000 closing costs rolled together. It's 408,000, and the new rate is 5.5. The 30-year clock starts over at this point. Okay. But the new payment is $2,316, which is a savings of $212 a month, right? So the payment is $212 a month cheaper. That's $212 in savings. It's real, but it cost you $8,000 to get it. So hold that thought because we're going to come back to it. Your long-term reset, if you were 7 years into your old loan, right? So let's say you had a 30-year and then 7 years, you decided to do this refinance. You had 23 years left. But what you did is you essentially gave back those 7 years when you did this refinancing. So you'll pay more in total interest unless you keep refinancing aggressively. All right. So, what are the actual pros and cons of refinancing? Refinancing is a much bigger transaction than recasting. There's a bigger upside in most cases, but bigger trade offs that you do need to understand. So there's lower interest rate. When rates have actually dropped significantly, you can lock in real long-term savings. There's the change in the terms. You want to be debt free faster? You can. You can refinance from a 30-year to a 15-year or stretch out a 15-year for lower payments. Now, you also have access equity. So you can cash out, do a cash out refi, and that turns your home's equity into actual money that you can use now, right? It's not hidden in the walls. And then there's the PMI drop. Now, we talked about that in previous weeks, that if you have 20% equity into your home and you want to refinance into a conventional loan, because maybe you were in an FHA before, got an FHA because it's easier to get into the home, but now you have 20% equity. You want to drop that PMI and you want to change that loan. This is huge for FHA borrowers, especially refinancing to conventional, because that again can eliminate that PMI, which could be a couple $100 a month, and you can eliminate that entirely. Now, the closing costs are typically 2 to 5% of the loan. So on a $400,000 loan, that's $8,000 to $20,000. This is the killer. Okay. And then it resets the clock. That's a con. Starting your 30-year loan over could mean paying significantly more total interest over time, even with a newer rate. And then you have to go through the full underwriting. So credit check, income verification, appraisal, debt to income review, the whole shebang. And then there is the time. So 30 to 60 days from the time you make application to the time you close with this new refinance loan. And it's not a fast process in most cases. If today's rate is higher than your current rate, refinancing will hurt you, not help you. How do they really stack up against one another? Well, let's put them side by side and let us take a look. This is the slide I want you to take a screenshot of because everything we just discussed lives in this chart, this one chart. Row by row, we're going to compare the cost, okay? So recasting is a couple $100s, refinance thousands just on cost alone. So there, recasting wins by a mile when it is available to you. And then we talk about documentation. Recasting requires almost no paperwork. Refinancing requires everything that you did to get in the house initially: credit, income, appraisal, the works. The interest question: recasting keeps your rate the same. Refinancing requires you to change it, okay? It requires a change in that rate. This is the single biggest decision factor, okay? And then the long term: recasting keeps the same payoff date. Refinancing usually resets the clock. Speed: recasting is about 2 to 4 weeks, and refinancing is typically 30 to 60 days. And then eligibility: this is where refinancing wins. Almost any type of loan can be refinanced. For recasting, it's limited to mostly conventional loans. Notice how many wins there are on the recasting side as opposed to the refinancing side. Now you see why I call it the best kept secret.
So, when does each one win? Let me make this crystal clear. Recasting is the right answer when one or more of the 5 things are true. If your current rate is low, so if you locked in at a 3 to 4% interest rate during 2020, 2021, protect that with your life, because today's rates dance between 6 and 7%. So refinancing today would mean a worse rate for you.
Okay. If you've received a windfall of cash, inheritance, bonus, business sale, lawsuit settlement, investment, property proceeds, when you have a lump sum, recasting is often the highest return use of that money. When you bought before you sold, which is a common situation. You bought a new home before selling the old one. You took on a bigger payment, and now you need to apply the old home's proceeds to lower the payment on the new home. Then recasting works.
When your goal is cash relief, you don't need to change anything structural. You just need lower monthly payments. Then recasting is surgical because it does only that.
Okay. And when you want to avoid underwriting, if you're now self employed and you were a W 2 employee when you initially purchased your home, if you're between jobs, if you've recently retired, your income picture might make a refinance approval difficult, but recasting doesn't care about any of that. Okay. Now we're going to flip it and we're going to tell you when refinancing wins.
Refinancing wins when the loan itself needs to change, not just the balance.
The general rule you want to see is at least 0.75% to 1% below your current rate to justify those closing costs. If you don't see that, it's just going to take you too much time to recoup the money that you'll put in to refinance. Because remember, refinancing typically costs money in most cases. All right. Refinancing will win typically when you have an adjustable rate mortgage. Okay. Because adjustable rate mortgages can be a ticking clock. If yours is about to adjust upward, refinancing to a fixed rate is often essential for stability.
Refinancing may win when you need to drop PMI, and this is a big one for FHA borrowers. FHA mortgage insurance often cannot be removed when you hit 20% equity. So you can't just call up your lender and say, hey, I have at least 20% equity in my home, drop my PMI. Most of the time, you will have to refinance out of that loan into a conventional loan for that PMI to be eliminated entirely. And then if you need cash from your equity for, let's say, a major renovation, debt consolidation, college tuition, a business investment, this is when a refinance may win, because recasting can't help you here. Only a cash out refi gives you that usable money. when you want to shorten your term. So going from a 30-year to a 15-year can save tens of thousands of dollars in interest over the life of the loan, but you will have to make a higher monthly payment. Now let me make this concrete with two real client stories.
We're going to talk about Maria and James, a real Houston area couple. The names have been changed, obviously, but they are the perfect example of when recasting saves the day. So,
Maria and James are married with two children. They purchased their home back in May 2021, right at the bottom of the rate cycle. They got a 30-year fixed at 2.875%. So amazing. Lucky timing, right? Okay, so their balance is around $385,000. Their monthly principal and interest was at $1,597, which is extremely manageable. In 2025, they sold an investment property and walked away with about $60,000. And then the question became, what do we do with this money? They had two options. Option A, refinance. Option B, recast. Okay, so today's rates are about 6.75%. If they were to refinance, they would give up their 2.875% interest rate, and closing costs would be about $8,000. That's a brutal number because that would mean that their payment would go up by $510 a month, and they'd pay $8,000 in closing costs just to make things worse. This is exactly the trap that I see homeowners falling into. They just assume that refinancing always saves money, and that is simply just not true. Okay, let's flip over to option B, which is recast. So for them, this was the winner. I'll spoil it for you, okay? So they applied the $60,000 to the principal. They paid a $250 fee, and they kept their 2.875 interest rate, which means they kept the same payoff date. Their payment did drop by $249 a month. So they protected their incredible rate and they lowered their monthly payment. That's $3,000 a year back in their pocket for a fee of $250. This is the kind of decision that compounds for decades. So now y'all remember in math where the teacher said what you do to one side you have to do to the other. So now let's flip this thing on its head and let's talk about when refinancing is unquestionably the right move. So we're going to stay where we are with our case studies. And this time I want to introduce you to Marcus. This is going to be the strategic refinance example. All right, so Marcus was a first-time homeowner, single guy. He purchased his home late 2023 with an FHA loan. So he received a 30-year fixed rate at 7.625. I know, tough timing because rates were near their peak at that point. His balance, though, is $310,000 with a monthly P&I payment of $2,193. But the killer was he also paid $268 a month in FHA mortgage insurance. So his total payment is more like $2,461. Fast forward to today, his home value has climbed to $385,000. He now has 24% equity, but he has no lump sum, no windfall coming. So you don't have all that money coming. So option A for him, recast. Let's walk through that. So there were two strikes against him for that because FHA loans typically cannot be recast at all. And he doesn't have a lump sum of money to apply, like I said. So the quick verdict was recasting was simply not an option for Marcus. Option B was to refinance, which he elected to go with option B. Now, Marcus refinanced his FHA loan into a conventional loan with a 6.25% interest rate. And he was able to roll his closing costs into the loan, and those closing costs were $7,800. Now, here's his double win. His new payment is now $1,956, and because he had 24% equity on that conventional loan, he now was able to drop the $268 monthly mortgage insurance entirely. So the total savings that he now gets to enjoy is $505 per month. That's over $6,000 a year. And those closing costs will be paid back in about 16 months. So for Marcus, refinancing wasn't just better, it was the only option. Two completely different clients, two completely different answers. Now I want to clear up some dangerous myths that I hear all the time. So if you take nothing else from tonight, please take these 4 myths because they are costing real homeowners real money every single month. Myth number 1, refinancing always saves money. This is the most expensive misconception in real estate. If your current rate is lower than today's rates, refinancing will actually cost you money. So always run the break-even math first. Myth number 2, recasting is the same as paying extra. That is a definite hard no. Paying extra principal shortens your loan, but your required monthly payment stays the exact same. Recasting does both. It pays down the principal and lowers your required payment, and there's a big difference. Myth number 3, all lenders offer recasting. Well, in fact, many do not. And many lenders that do offer it don't advertise it because they make more money on refinances, right? You have to ask specifically. Do not assume, because you know what happens when you assume. Myth number 4, closing costs are no big deal. Well, on a $400,000 refinance, $10,000 in closing costs takes about 4 years to recoup. So if you sell or refinance again sooner, you're going to lose money. So we're going to calculate this together in just a few slides. But how do you actually know which one is right for you? So you want to start off by asking yourself 6 questions.
Okay, we're going to walk through these and we're going to be honest about it before you call a lender. The answers will tell you which path to take. Question 1, what's my current interest rate? If yours is lower than today's market, refinancing is probably wrong, period. Hard stop.
Question number 2, do I have a lump sum of money available? Without the $5,000 to $10,000 minimum, recasting just is not on the table. It's not even an option, okay? Question 3, how long will you stay in the home? If you're going to be moving in the next 3 to 5 years, refinancing closing costs may never pay off. So think about that long and hard. Question 4, what loan type do I have? Do I have an FHA, a VA, or USDA? Because usually those loans can't be recast. Conventional loans typically can. Question number 5, do I want lower payments or am I seeking a faster payoff? Remember, recasting lowers payments. A 15-year refi is the play if you want to be debt-free faster though, okay? Question 6, do I need to tap into equity? If yes, only a cash out refi will work, period. Recasting cannot give you money back. Write these 6 questions down or take a picture, bring them with you to any conversation that you are having with the lender, and trust me, they'll respect you more because they'll know that you did your research and you will get better answers. Now, I promised that we'd walk through the break-even math, so let's do that because this is the single most important number to consider when refinancing. Get your phone or get your pen and paper, whatever you're comfortable doing, because this, again, is important math that you want to do before you even consider refinancing. And it's so simple that even a 5th grader can do it. So the formula is what we want to concentrate on. And that is simple and plain. The break-even months equals the closing costs divided by the monthly savings. Ta-da! That's it. Closing costs divided by how much you save each month. Now let's work an example. Let's say you have closing costs of $8,000 a month and the new payment saves you $212 a month. So that would be $8,000 divided by 212, and that would equal 38 months. So that's just over 3 years, to break even. Now, the critical question that you should ask yourself right now is, will you stay in the home at least that long? If you'll be there 10 years, then yes, refinancing is great. But if you might move in 2 years, then you're going to lose money. And this is probably not the best option for you.
What do you think your closing costs would be? What's your current payment? Let me know that, and I'll do a quick calculation for you. Now, most experts say if your break even is more than 5 years, the refinance is probably not worth it. But this is just your simple break even. It doesn't account for the impact of resetting your loan term, which could add tens of thousands in extra interest over the long term. All right, so pulling it all together, let me give you a simple decision framework. Okay, this is the framework I walk every client through. Two questions, and you have the answer.
Step one, you want a lower payment. We all do. So let's find your path. Question one, is your current interest rate lower than today's rates? If the answer is yes, then we move to the next question, which is, do you have a $5,000 plus lump sum? If yes, then recast. That's the answer. You'd be crazy to give up a low rate. Apply your lump sum, keep your great rate, lower your payment. Now, let's talk about the flip side. Let's go back up to the top for the very first question, which is your current rate lower than today's rates? If that answer is no, then the next question is just below. And that one is, will you stay in the home for 5+ years? And if that answer is yes, you have your decision, refinance, because you already told me that your interest rate is higher than today's rate. So you will be afforded a lower rate, right? And then you'll also be there long enough to recoup those closing costs. But just to confirm, run that break even math and that'll give you your answer. Sometimes, though, a hybrid strategy works best, and that is refinancing to a better rate and then at closing applying a lump sum for an even lower starting balance. Not every lender will set this up for you, though, but the smart ones will.
So, what should you actually do when you log off tonight? Here's the plan. Knowledge without action is just trivia. Here are 5 concrete steps you can take starting tomorrow morning. Step one, pull your loan details. Find your latest mortgage statement, write down your rate, your balance, your monthly P&I, and your remaining term. You need these 4 numbers before doing anything else. Step two, call your lender and ask 2 questions. Does my loan allow recasting? And 2, what's your fee and minimum lump sum requirement? Don't volunteer any information, just get those 2 answers. And step 3, get refinance quotes. Call 2 or 3 lenders, ask for a loan estimate. That's the official document that shows all closing costs. Don't accept verbal numbers. You want something in writing. Step 4, run the break even math. Closing costs divided by monthly savings. Compare that number to how long you'll realistically stay in the home.
And step 5, this is what I do for my clients. So I want you to call me if you need. Okay, there's no cost to talk through your specific situation. I can help you model both options side by side with your real numbers. And even if you don't call me, okay, that's fine. Please don't make this decision in isolation. Get a second opinion that isn't financially motivated to sell you a refi. So now with that being said, that's the heart of tonight's session. So now let's get to your questions.
There are no dumb questions. The questions you're afraid to ask are usually the most important ones. All right. Any questions?
Yeah, that's some questions. You gave me a lot of good information. Recasting, that's a term I've never heard before, because I guess
Okay.
it's so common to hear refinancing.
Mm-hmm.
But is there a certain amount of time to be in a home to make a decision on either way you want to go?
That is a great question. In fact, the answer is it depends. It depends on the loan type and whether you're refinancing or recasting, since those are two different processes with different rules. Refinancing has seasoning requirements, and most loans require a seasoning period before you can refinance. So, conventional loans offered through Fannie Mae and Freddie Mac, the rate and term refinance generally have no seasoning requirements, though some lenders impose a 6 month time period. For cash out refinances, 6 months of ownership is required, with some exceptions for inherited property or delayed financing. Now, on FHA loans, there's a streamlined refinance rule of at least 210 days from the first payment due date, and at least 6 monthly payments have to be made. If you want to do the rate and term, no cash out, there's a 6 month rule of payments that's typically required. And then if you want to do a cash out refinance on an FHA, there has to be 12 months of ownership and on time payments. For VA loans, the interest rate reduction refinance loan, there are 210 days required from the first payment and at least 6 consecutive monthly payments. And for cash out refis on VA loans, the same 210-day 6 payment rule applies. Now, on USDA loans, that typically requires 12 months of on time payments before refinancing can be approved. And jumbo loans vary by lender, but often there's a rule of 6 to 12 months. Now that's on refinancing, okay? Now for recasting, since that's different, and we just went over all the ways that it is, most lenders will require 90 days of payments before they will allow you to recast.
A lot of good information.
Mm-hmm. Mm-hmm.
A
Mm-hmm.
lot. Yeah.
I
Um,
had okay, I'm sorry, go ahead.
no, go ahead. Go ahead.
So I had a couple questions posed to me when I did this poll on social media, and they asked, "Can you do both? Can you recast and refinance?" And the answer is sometimes. So yes, sometimes. Some lenders allow you to refinance and apply lump sum at closing for a hybrid play. Okay.
Okay.
The other question that I got was, will recasting affect my taxes? I'm not a tax person, so I can't tell you 100%. What I can tell you is to check with your CPA. And what I've seen, usually the answer is no. Recasting doesn't change your interest deductibility unless your situation is unique. But again, always check with your CPA. Other question I got is, what if I'm thinking of selling soon? Well, if that's the case, neither option may make sense. The shorter your timeline to sell, the less either option pays off. So keep that money in the bank and earn some interest on it. I would say if you're selling soon, don't even think about this. It's not worth it in most cases. And
Okay.
then two more questions I got. One was, should I pay extra principal instead? That is a different goal. Extra payments shorten the loan, but don't lower your required payments. Okay. Recasting lowers your required payment. So you have to figure out what your goal is. What's your goal? Is it to pay it off early, or is it to lower your payment at the moment? And then the last question was, does recasting hurt my credit? No, because it's no credit pull. It's no hard inquiry. Refinancing does though. It will temporarily, just like it did, when you initially purchase a home. But it's only temporary. Okay. So those are the questions that I got. I hope I didn't answer something you wanted to ask.
Oh, they're good. Good answers.
Good deal. Good deal. Anything else?
No, I don't think so. See, you got another somebody
I'm
else.
so glad that you said what you said about, well, I hadn't heard about recasting before, because
Haven't.
so many people haven't. And again, that is why I'm so excited about this 52-week Wednesday webinar, because that's what we want. We want to unearth, we want to move some rocks and get some gems from underneath these rocks, and give people that information to make more informed decisions, right? Because I mean, you get in here and you want to be a successful, healthy homeowner. And the only way to do that is for people like me and other people in the industry to come off of some of this knowledge that we have and stop gatekeeping. You know, that's just ridiculous. Any other questions? Are y'all
No,
there? Oh, okay.
yeah, I'm still here. I was trying to remember how you was explaining about look at different lenders to get information, and I was wondering those lenders, is there a fee to request that information?
No, because they're not giving. So the fee typically kicks in when you are getting your credit pulled. They
Okay.
can do what's called a soft pull, and that
Mm-hmm.
doesn't have there's no fee associated with that. And they're just giving you an idea. So no, there's no fee associated with it. Um, you won't give them authorization to do a hard pull on your credit. They're just literally going by what you're saying. So they're giving you information based off what you're saying. So if you tell them my credit score is 760, I make $7,600 a month, my debt is $1,200, they're gonna just take your word for it for that.
Okay. Good to know.
Mm-hmm. Mm-hmm. And it's just an idea, it's just an idea of what those numbers could look like. And then they'll tell you that, hey, this is not a promise to lend. This is just for the purposes of, just getting started, exploratory information.
Okay.
Mm-hmm. Anything else, guys? All
Not for
right.
me.
So I am happy. I'm happy and thankful that you guys chose to spend some time with me. It is 7:43 and I'm over my time. And y'all know how I feel about being a good steward of my time, but more importantly, you guys, I want to respect that. But I want to remind you that if you have anybody with any real estate questions, whether they're looking to purchase a home or sell a home, or I don't know where to start, I don't even know if I want to do this, I just have some questions, um have them give me a call, have them invite them to join us. We're here every Wednesday at 7 p.m. And I want to remind you guys, for all of your real estate needs, my name is Daphne Brown, broker owner of Beyond the Home Realty, and I am always ready and willing to enable you to find your way home. Till next Wednesday, bye.
Thank you for joining us tonight. If you've missed any of our past webinars and would like to catch up, we have a playlist right here.